Hello, everyone. My name is Richard Leggett. I'm the CEO of FrontierView. On behalf of my colleagues, we welcome you and thank you for joining this episode of GlobalView. Let's call this one our summertime edition. This month, I will once again be speaking with my colleague, Elizabeth Rust. She's FrontierView's lead economist, and we'll be talking about some of the major global macro level issues that our multinational client base is grappling with currently. And as usual, there's no shortage of topics for us to dive into, especially as calls of an impending recession in both the US economy and the global economy appear to be growing louder. And that's obviously a concerning state of affairs for our clients who have already begun grappling with high inflation, extreme cost pressures, and supply chain challenges over the last year. So Elizabeth, welcome. It's good to see you.
Thank you.
In this challenging environment, number one, I'm wondering if you're getting any rest, but more importantly, I'm curious to know what issues that you've been discussing with our clients lately. Let's talk about our top three.
Yeah, never any rest, especially I think ever since the last year, and particularly not since March. And I know it's probably the same for our clients who've been, working on reworking their strategic planning over the last few months. So on that note, here are a couple topics that have been bubbling to the top of the agenda in a lot of our client conversations recently. We'll start off talking a little bit about the issue of Europe's energy supply situation and what we're worried about in the months ahead. We'll ask ourselves what's going on with oil prices. We've seen a little bit of a drop in crude prices the last week or so. Is that for real? And third, let's talk a little bit about the dollar, since there's been some action there in the last week as well.
All right, that sounds great. And I might, if time allows, sneak a few lightning round other questions in off script, if you don't mind. So let's start, though, with the issue of Europe's energy supply. Obviously, this is an issue we've been following quite closely for a number of months. We've touched on it in previous episodes of GlobalView. And in fact, we actually featured this topic last year in our annual Events to Watch report, which I think we published in November. And we talked about the possibility, and this was before the war, that Europe would see a severe spike in natural gas prices that would cause the potential for rolling electricity blackouts and drive governments to ration national gas supplies. And this has always been a fear in European security policy circles, that the EU might one day face a reckoning on its dependence on Russian energy. And now it looks like we might be facing that day. So is this all a fair characterization, or am I over dramatizing things?
No, I think the drama is there, and it's a fair characterization for the most part that the EU is facing a reckoning on its natural gas supply situation. And maybe I'll start off with just a couple charts to take stock of the situation and illustrate where we are. So first off, this is the benchmark natural gas price, the European natural gas price. It's showing in this chart price over the last 5 years. And as we know, in the last 9 months or so, we've seen a big surge in prices that has not come down. And it's a surge that's been characterized by extreme volatility, particularly since Russia's invasion of Ukraine. On balance, natural gas prices have been about 8 times higher than the historical average over the course of this year. And obviously, that's already led to a lot of problems for Europe's, for its industry and generally for, it's a big contributor to high inflation in Europe. All of that has to do with persistent supply risk in Europe. So an actual drop in gas flows starting late last summer, as well as the persistent risk of further declines in gas flows. That's been behind the high prices we've seen the last few months. And we experienced a big change in mid-June that actually, in my view, has been reported on and is being talked about, but probably hasn't gotten as much attention as it deserves. And so we're raising it in client conversations. Clients are asking about it, but potentially not as much as they should be. And it has to do with what you can see in this chart. So basically in mid-June, Russia announced that it was going to begin cutting gas flows through the Nord Stream 1 pipeline. That's the one that runs through the Baltic Sea in Northern Europe. And its explanation was, that it was missing a part that Siemens was supposed to deliver and could not due to the impact of sanctions. It's a little bit of a red herring. It's kind of viewed more broadly. It's quite clear that the cutoff is a form of retaliation against the EU's institution of an oil embargo several weeks ago, especially given the timing. And as you can see, since mid-June, we've seen a big drop in physical gas flows into the EU from Russia. It's down about 65% compared to where they would normally sit this time of year. And it's not actually clear that that decline has bottomed out. So it's a big drop, and it could go down further. So obviously that's contributed to some of the price increase. You can see in this chart the prices have been rising again. They haven't quite hit their previous peak, but are quite likely to in the coming weeks.
So yeah, this is alarming, and we know the gas flows have plummeted. It seems like it will be a huge deal for any entity or industry in Europe that relies on electricity or natural gas in feedstock. And also, we're in the summer, right? So we're not even in the winter months yet. It doesn't feel, as you point out, that Europe is approaching this in kind of crisis-like mode yet, or that there's been any material negative consequences that have bubbled to the surface. But are we missing something, or where do you see this going?
Yeah, so I think the reason it's not in crisis mode yet is that it's only the beginning. And it's, again, been a persistent fear that, one day Europe would face a drop in flows from Russia. And, we started having clients ask about what this looks like starting a year ago. But, since it's never happened, we don't know quite what it looks like. But let's talk about what we can begin to imagine might occur in the next few weeks and months. First off, I indicated that this may not be the end of the drop. And actually, one thing to point out, you see in this chart how around mid-late July every year, you see a big drop in flows in a typical year, even before all this began. That has to do with annual maintenance that Russia Gazprom performs on the Nord Stream 1 pipeline, just typically every year. The fear is they'll head into that maintenance season later this month and decide to never bring the gas flow back on afterward. So again, that's a clear and present risk. So it could get even worse from there. But even with a 65% drop in gas flow, Europe is in trouble. And the reason is that, and this again goes in a typical year, you need the summer period to reshore gas inventories before you head into the winter, which is the period of the year of peak consumption. In light of the persistent supply risk, especially since the war in Ukraine, the EU has pushed for Europe to reach 80% of its storage capacity by the beginning of the winter. Before this drop in gas flows, it was at about 55%. It was doing quite well toward reaching that goal, but it was reaching that goal through the purchase of Russian gas. So now it's not quite clear how Europe is going to manage to reach that 80% threshold, which is what it needs to get through the winter. So again, even with the drop that's occurred already, Europe is in trouble as it heads into the winter. There may be, some forms of reprieve if there are other sources they can turn to, or if we head for a mild winter. But again, we don't know until we get to the winter whether it's going to be mild or not. So it's a big concern.
Do you see any hope of avoiding a total kind of crisis? I mean, obviously you can do some rationing and that sort of thing, but none of this is good for citizens or good for companies.
Yeah, so in the last several months, the EU has done a lot to wean itself off of Russian gas, and it's gone obviously kind of through two big picture routes. One is through finding natural gas through other sources, either by pipeline from other neighboring countries or through increased imports of LNG, which has been probably the biggest area of growth and kind of the avenue it's pursued with greatest energy. And there's been some success through those measures. There's been a big increase in imports of liquefied natural gas from the United States, for example. But these measures, they're not foolproof. First off, we've had actually a fire at a major LNG export terminal in the United States called Freeport in Texas. And that's taken off about 20% of export capacity in the United States that likely won't return until the end of this year. And by then, Europe's already in the middle of winter. So that's been kind of another wrench thrown into this plan. The other route Europe has pursued is through fuel switching, for example, reopening coal power plants to try to take away, the natural gas needs in the electricity grid, and then through some amount of just intentional demand destruction. So passing on costs to households and businesses and making them, bear some of the brunt of the pain, which is a departure from what a lot of European governments were doing earlier this year. They were trying to cushion the blow. But it's increasingly difficult to see how Europe makes up for the shortfall without some amount of energy rationing. So not even just demand destruction, but governments literally taking the role of saying who gets gas supplies at what time. And that's now what we're highlighting for clients to prepare for starting this winter.
Yeah, so let's talk about that. If you put your client hat on, how do you prepare, and how does it affect different sectors and different geographies?
Yeah, so first off is simply to take stock of the distributional impacts of how energy rationing works. If you think about rationing, it inherently implies that some people are getting energy while others are not. What most national governments have outlined as priority sectors include households. They don't want people to freeze in their homes in the winter. Small businesses, local services, healthcare, and then some critical industries, food processing, pharmaceuticals, anything that is sort of clearly essential and also politically sensitive. What they haven't highlighted, in as much detail is by nature who is therefore not getting energy. But to deduce is basically think about which are your energy intensive industries that aren't in that list. So I would highlight chemicals, for example, anything outside of pharmaceuticals in the chemical space, any other kind of energy intensive manufacturing, potentially auto manufacturing, although that's a complicated one since they've already been dealing with, shortages in production shutdowns now and are kind of already in that hole. To some extent, we won't know until this starts playing out, but we recommend that clients simply, first off, stay on top of what governments are saying they're going to do. Most national governments in Europe have explicit plans that they're laying out for what energy rationing will look like. Beyond that, there's geographic variation that we're expecting. Generally, Western Europe, extreme Western Europe, so Iberia and France, are a bit less exposed to a drop in Russian gas flows. They're farther away. They rely on other sources. Germany and Northern and Eastern Europe are more exposed, so there's a consideration there about whether to source from the western parts of the continent that are a bit less exposed. But more broadly, this will affect our entire client base. Any multinational that sources at all from Europe or sells at all into Europe is going to be affected by this. Developments since June have led us to revise down even further our growth forecast for Europe. We're expecting as a base case a recession beginning in the second half of this year, so pretty imminently. And that obviously has big knock-on effects for global growth. It will also affect global supply chains. If you're getting a decline in European manufacturing production, that spells shortages of inputs in other areas of the world. So generally for clients, prepare for this and think about your exposure to Europe as we head into the winter months.
Okay. Let's move on to the next topic. I feel like we could talk about that topic more, but I do want to hit the other topics. So we're going to keep, though, the focus on energy. We've talked a lot about gas, but that's not the only source that we've seen a lot of movement in the last couple of weeks. What is going on with oil prices? We saw a huge spike, then we saw oil dip below $100. Now it's back just over $100. What's happening, and where do we see this in terms of moving forward?
Yeah, so just to summarize generally where crude oil prices have been trending the last several months. Obviously, since the Russian invasion of Ukraine, they broke above $100 a barrel for the first time since 2014. And it looks a bit like a phase shift if you look at the time series. So basically, ever since then, they've been hovering in the $100 to $125 a barrel range, with some volatility in there based on events related to the war and other factors. But they've been relatively high ever since. We have seen a bit of a drop in the last couple of weeks, as you mentioned, breaking below $100 a barrel for the first time since April, followed by a little bit of a recovery, but not back up to the levels where we were a couple weeks ago. The biggest the narrative around this drop is that it's markets internalizing the risk of the global economy tipping into recession later this year. A recession entails some amount of demand destruction for oil. People drive less, people fly less when household incomes come under pressure, reduced business activity, etc. All of that lowers oil consumption, which will, all else equal, lead to a leading in prices. So the idea here is that traders are getting ahead of that. There are a couple of other factors beyond that. Some of it is the realization that China is continuing with its zero COVID policy, and that we're going to see further lockdowns, in general over the course of the next 12 months. Timing is often unpredictable, but every time a major urban center in China locks down, it takes away a good amount of global oil consumption.
Big talk about that in the news, even this morning ahead of this recording.
Yeah, exactly. And then there are some technical factors behind the price decline as well, which might be temporary in nature. So to answer the question head on, is the recent drop in oil prices for real? A little bit, but we're still expecting relatively high oil prices to persist for at least the next year or so. So just to illustrate, we actually came out with revised oil price forecasts earlier this week. Our 2022 annual average forecast for Brent crude is now at $109 a barrel, slight downtick from where we were before, $111 a barrel, not a material change. And we've also just published our 2023 average Brent crude oil price, which we expect to be at $95 a barrel. As you can see, there's still pretty elevated numbers, all things considered. So they're a little bit of an easing from where we've been the last several weeks. But overall, we're expecting things to remain in a pretty high oil price environment. As you can see in this chart, overall, we expect stronger upward price pressure in the near term. A few factors behind that. One of them is the issue of pent-up travel demand, which has obviously driven up demand for jet fuel in particular with this global air travel recovery. And just based on seasonal factors, that's hitting in the near term. There are quite a few factors actually behind these forecasts, and a global recession is not the only one.
Elizabeth, high oil prices are incredibly salient political issue right now in the United States, given that it affects everybody at the dinner table, if you will. So even though we expect oil prices to remain high, does the fact that they're expected to average slightly lower than where they have been mean we can expect easing gasoline prices and therefore maybe an easing in core driver of inflation in the U.S.?
So as a general principle, if you take the price for anything, even if it stays high, as long as it's stable or fluctuating in the same range where it is currently, that contributes to easing inflation, given that inflation can be thought of sort of as a flow. It's a change in the current prices. So if you get a stabilization in the prices underlying it, you get lower inflation. But there's something a bit extra going on when we talk about gasoline prices in the US. It's been a politically salient issue since, as you may have noticed, there's a bit of conversation around this, especially coming out of the Biden administration, with the accusation that oil refiners or gasoline retailers are benefiting from this oil price environment because they observe that gasoline prices are a lot higher relative to historical average than crude oil prices are right now. So you see here, for example, on this slide, crude oil prices are sitting in a pretty similar range to where they were in 2013, 2014 right now. But gasoline prices are, I believe, about 30% higher than they were in 2013, 2014. That's definitely the case in the US, and to some extent, it's a global phenomenon, actually. which is why it's probably not quite correct to say that it's pure rent seeking on the part of gasoline retailers in the US, because it's a global phenomenon and it has to do with tight global refining capacity. So just like we've been dealing with tight capacity in a number of industries ever since, we've emerged from pandemic lockdowns, it's the same thing with oil refining. And again, similar theme, some of it has to do with the war, because Russia accounts for a decent share of global refining capacity, and some of that has been taken offline. It also stems a bit from underinvestment in refining in the United States for a good 10, 15 years now. And so all of a sudden, we've kind of had a reckoning on the issue of tight refining capacity. So that's what's driving this big premium in the price of refined petroleum products over crude. And it's not just gasoline, it's jet fuel, diesel, any refined petroleum product is costing quite a bit more relative to historical average than crude at the moment. No obvious end in sight to this issue of tight capacity. It probably necessitates, again, some amount of demand destruction. So same deal, we're probably expecting high gasoline prices to persist, but if crude oil prices stabilize, it will likely take some of the pressure out of the system.
Okay, so maybe we've reached some sort of a plateau.
Yeah.
Okay, good. Let's move to the last topic, and then hopefully, if time allows, I'm going to just ask you a couple of other quick questions. But the last topic was about the U.S. dollar. We've seen a sharp movement here, and just in the last few days. So timely topic. Give us kind of what's going on, and then we can talk about the implications.
Sure. So yeah, we've seen a lot of movement here, even just in the last few days. On Tuesday, so just on one day, we saw a big jump in the dollar index, which is just an index of the dollar's value against a basket of currencies. It jumped by about 1.5%, so implied that the US dollar jumped in value by 1.5% against most global currencies. That is the same as saying that most currencies depreciated on average by about 1.5% just in one day on Tuesday. And that jump has held, so it was not kind of a sudden spike that then came back down. And for certain currencies, you saw an even bigger drop. So the euro is now close to reaching parity with the dollar. It hasn't been our call that it would quite reach parity, but it's at the point now, it's sort of on the threshold. It could happen or it could not. The pound dropped quite a bit. The yen has been under lots of pressure all year. It dropped a bit as well. Even some currencies that had been holding on quite well until recently have seen a bit more of a drop lately. The Mexican peso, the Chilean peso as well. So it's actually the continuation or even intensification of a trend that we've seen over the last year. So actually, just to illustrate, this is the dollar index that I mentioned earlier. When it goes up, it implies the dollar is stronger and that other currencies are depreciating. And as you can see, ever since middle of last year, the US dollar has been on a relentless appreciation trend. In general, we expect that to continue. There are a few factors kind of moving in various directions, but all told, given the latest regarding Fed policy, what's happening in the global economy, we're expecting on balance net continued appreciation of the dollar against most other currencies, at least through the end of the year. And we also expect kind of continuation of the same trends in terms of which currencies are most under pressure. And it's actually interesting to see, just take stock of what's happened so far this year. So this map shows us the percent appreciation or depreciation of each of these currencies against the US dollar since the very beginning of the year. Red referring to depreciation, green appreciation. And you can see which currencies, first of all, you see a lot of red. So most currencies have depreciated against the dollar this year. A few in yellow where they've held on. A lot of that has to do with capital controls. In some cases, you can see a lot of those currencies that have held on are oil exporting countries or other commodity exporting countries that have benefited a bit from high commodity prices in the last few months. And then a small handful of currencies that have appreciated. Obviously, in the case of Russia and Belarus, specific impacts of the war, and capital controls that those countries have put in place. And then, a couple of markets in LATAM, for example, have appreciated a bit, benefiting from high commodity prices and from early central bank action as well. Overall, I don't think we expect this picture to change considerably. So the currencies that have been under extreme pressure, again, the euro, the pound, the yen, number of currencies, in the Middle East and Africa, are likely to continue to stay under pressure. That there's, not really a big shift in the overall trends that we're expecting.
So if you're again putting your client hat on, what's the guidance you would give to clients as it relates to the currency trend?
Sure. So obviously, from a financial management perspective, and what CFOs should think into about, just to incorporate our currency expectations directly into your forecast when it comes to capital budgeting around the world, or in consideration of repatriation of cash flows, that whatever you might have been expecting earlier, could have changed based on how much currency movement we've seen this year. And I'll emphasize that this is, extreme currency movement, or extreme is maybe a little bit extreme to say, but certainly kind of, a historic movement in currency, dramatic, that we've seen in the last several months. I'd also highlight just there are a number of medium-term implications from this kind of, again, dramatic currency movement. And this is something that, as analysts on the global research team at FrontierView, that we will, keep track of and keep on top of for you, but we recommend that, our clients stay in touch with us on this, is that where countries have seen extreme currency depreciation in the last several months, it's going to negatively affect their sovereign debt dynamics. It will negatively, affect their macroeconomic outlook, especially through increased imported inflation. So it's contributed to a lot of these inflationary pressures we've seen in countries where we've seen a bigger currency drop. So it just, all else equal, you've got a deteriorating macroeconomic outlook for those countries which have seen faster currency pressure. One I'll highlight again is the Eurozone. There's been increased concerns again about a potential Eurozone crisis 2.0 stemming from this degree of currency value decline in the last several months. So just, to stay abreast of these issues in your market monitoring process.
Okay, yeah, and I'm sure we'll come back on that topic and that. Okay, I just wanted to ask you one last question. I know we're bumping up against time, but I am very curious about the labor markets, because the labor markets have been so tight, and they've been another driver of inflation. And yet it feels like with, you use the word demand destruction repeatedly in this discussion. Will we see some sort of loosening of the labor markets, or do you still envision, because it would be very odd to have like a recession, a global recession, and still have kind of full employment or tight labor markets? That those things usually don't kind of appear in the same sentence. So kind of curious what your view is.
Yeah. So obviously, across all the global markets we cover, there are always kind of country-specific labor market factors. So I'll focus this answer a bit on the United States, where we have a lot of data, and which often speaks to what's going on, at least in other developed markets. It's actually interesting. We had the latest jobs report release actually come out right when we sat down to begin recording this session. So I haven't actually had the chance to kind of fully review it and, unpack all of the implications, but it was a big upside surprise. So generally indicated, continued fast hiring in June. And that was, again, a bit surprising in light of other signs of slowing in the US economy. We talked about this a bit in GlobalView last month, that we've just been seeing, quite a bit of negative data coming out of the US economy lately. We're now expecting a recession beginning later this year in the US. So yeah, you ask a good question. Why is it that that the labor market continues to be performing quite well? We have seen a little bit of weakness in certain areas. Jobless claims have been ticking up for several weeks now. So it's not that everything is rosy. But overall, the labor market still looks pretty strong. And I think you can interpret it in one of two ways. One is that we'll get a recession without any deterioration in the labor market, like the opposite of a jobless recovery, I guess, like a lack of job losses, whatever is the term you want to use. I need to come up with. But that there's something different this time around, particularly as we get out of the pandemic. And you've seen such robust demand for labor, particularly in those services industries that were affected by the pandemic, leisure and hospitality. We've seen quite a bit of recovery in the travel industry the last several months. So that's all, buoying demand for labor. And you could argue that that won't let up just because of where we are in the pandemic reopening cycle. The other way you can interpret this is just that we will see job losses just with a lag, that it might come later in the economic downturn. And that's, there's a lot you can argue for that stance as well, especially because the labor market tends to lag the broader economy a little bit. You tend to see earlier downturns, especially in manufacturing, business investment, and then is when companies start to look at, cost on the other side, and they include labor in that equation. So, I think this is an area we're performing active research and thinking, and I might punt and say, we're not 100% sure which of those two it's going to be, and it may even be somewhere in the middle. So some deterioration in the labor market, but maybe not as much as you would see in a typical recession.
Yeah, and I think part of that also depends on how long and how deep this recession lasts, which we will probably tackle in an upcoming episode.
Yeah.
All right, I think we're at time. So much to talk about, but I think we have to cut it here, Elizabeth. Thank you so much for the excellent and insightful discussion as always. I also want to thank Madeline Gordon, our producer extraordinaire, who's behind the glass producing each one of these GlobalView episodes, and special thanks to our audience as well. We've covered a lot of ground in a short time. If you have submitted any questions during today's discussion, we'll be sure to follow up with our responses through your client services manager. As a reminder, as FrontierView clients, you can schedule research briefings with Elizabeth or any member of the FrontierView Global Research team at any time by scheduling through your client services manager. And of course, all of FrontierView's research, award-winning Frontier data, and analyst insights are available and always updated on the FrontierView desktop and mobile application. And given some of the topics that we've talked about in terms of continuous market monitoring, I hope that you'll use those tools on a regular basis. This concludes today's GlobalView episode. We look forward to speaking with you again soon. And in the meantime, be well.